Good morning, all of you. Today, as we earlier planned, market is all about right now. We all know that currently and near 11,000 level, 10,500, 600 level in Nifty, and we have seen in the last couple of months, market has gone up significantly. Now, we will try to explain what exactly happened in the market in last 3-4 months and what is what we are seeing in the going ahead, where the market is heading. Now, we all know that in the month of March beginning, we have this corona impact which has impacted across the globe, and on 23rd of March, we have seen the Sensex drops to the point of 25,600 level from 42,000 level over a period of 7-8 days. So it has been a rapid fall because everything in place. So from 23rd March, we have seen the market has gone down to its rock bottom of 25,000. 25,900 level to today, like day after yesterday, day before yesterday, the market is at the range of 36,500 now. 4 months. Now, what has exactly happened in the month of March? And the volume, it's $1 billion is equal to 7,500 crore. So if you can multiply 7,500 crore with 3,000, you can able to understand. I will lose count of zeros in that. I will able to understand how much of money the US Fed has pumped in the month of March end, and that has reason. So why they have done that? They infuse a lot of liquidity in the market. So because of that liquidity, market we have we are. So that's number one point. There is a huge amount of infusion done by the US Fed from 23rd March till date, which is about tone of $3,000 billion. Okay, that's number one. Second interesting observation what we have found is opening in India. We have seen a lot of trading. So a lot, and they're doing trading from their home. So number one point of market moving up from 23,000, 25. Inflow also, apart from FII's inflow, by way of third reason why the market has moved up is that the interest rate. Now we have seen across the globe there has been a significant drop in the interest rate in different countries as well. So the drop in significance is so significant that investors find it more beneficial to park the money in equity than the fixed deposits. So what exactly happened here is that sorry, a lot of investors, they park money in equities, they do trading in equity in these 3 months. So these are the options of huge amount of domestic participation which we have seen in the last 3-4 months, because people are idly sitting at home and doing trading from the home. There is no fundamental reason why the market has moved up from there. So that is the 3 primary reasons why the market has moved to 36,000 level. Now the question is, should it be sustainable at this level? Because I hope everyone is able to hear me out. If you cannot able to hear me out, you can write in the question and answer in a question in the left hand side. So the question is, since market has moved up so much, where it's going to go from here? Okay, that's a major question that we have. Well, to be very precise, there are 3-4 interesting observations that we need to keep in mind while predicting where the market will go. Whether it will go from 36,000 Sensex level or 10,600 level Nifty level to 13, 14,000, or is go down. So depend on the 3-4 factors. Number one is the US election is coming up in the month of November. US election is very important criteria, and as such, we have seen that US Fed has pump in a huge amount of money in the month of March. So that US will continue to keep the market up till the time the election is over. So that's, and post-election, it depends upon the results of the elections. Joe Biden, the alternate of Trump, they have already mentioned in the election manifesto that they will bring in 25% corporate taxations if they win elections, apart from other things. So that's a huge negative from the market. So if Biden wins the election, so they will have a market repercussions going ahead. So we don't know exactly where US elections, who is going to win from here. So that's one important market observations will be US elections. That's going to happen. Second is that the corona impact. We all know that the vaccines is going to take a longer time. Now the important thing is that whether we go worse from here, I don't think so. We will go much worse from here. Yes, the number will increase, but the death and affection, death and infection rates probably will be. Those vaccine and all will take its own time. So if it goes much deteriorate from here, if again the entire globe again faces the same kind of second wave of corona problem, then the market will going to impact. That's the second reason that can have. Another thing which is quite obvious is that earnings is going to be bad. That's very much for sure. Earnings is going to be very, very bad for the corporates. I give you an example why the earnings is important out here. In the month of March, if you see the date, if you see the audited balance sheet of all corporates in Jan-Feb March quarter, March last 10 days, all the economy was shut down, okay, lockdown. Even for the 10 days lockdown, the entire economies in the company's balance sheet in the month of March was bad. So imagine in the month of April, May, June, and probably July, August, September also, when the market will not fully open up, how the corporate earnings will be. So corporate's earning will be absolutely muted, that's for sure. For the next 6 months or 1 year time precisely, the corporate earnings will be less. So if the corporate earnings will be less, there is no reason why the market can go up from here. Okay, so that's one that is very evident. So I have mentioned 3 points. One is the US elections, which is unpredictable right now. Second is the corona wave 2. Wave 2, we don't know when it will come or how disastrous it will be. That is also unpredictable. But what is very much predictable is that the corporate earnings will be very, very muted and will be very less. So that's for sure. Second thing which is very much predictable is that there will be a lot of NPAs. There will be a lot of defaults going ahead. In US, what happened that the government has actually buy a lot of junk bonds. You know, when I say that 3,000 crore rupees they have pumped in the market, they have bought a lot of junk bonds during this time. In India, that has not been seen. You know, there has not been, although the government has given, but it's basically for the AAA rating bonds that if the default they will buy. So in India, we have not seen those things. The losses which is there, which is going to be incurred, I don't think so. The businesses will able to absorb those losses. You know, we have seen the data right now in this April, May, June quarter. A lot of defaults have started coming up. You know, the June EMIs have come up. In a lot of companies, if you see, the June EMI has come up, but the April, May EMIs have not come up. So it probably will go for a default, or company have to absorb those losses, and this loss absorption will actually reflect in the balance sheet. When the moratorium ends, the government has increased the moratorium, we all know, till September. When the moratorium ends, because of the muted earnings, because of the less earnings, many company will go for defaults. That's for absolutely sure. So there will be stress in the corporate earning things. And if there is less earnings, muted earnings, market can never go up. So I have said 4 factors. 2 factors which is quite uncertain. One is the US elections, one is the COVID. 2 factor which is very certain, that is corporate earnings will be muted from going ahead. and there will be a kind of defaults or banks defaulting from going on, banks or corporate bonds and all those things are going on defaults. So a lot of companies are saying that, a lot of people are saying that AAA bonds are okay, but we have seen the default happening earlier also. You have seen the default happening in Vodafone and a couple of other corporate bonds. I see that because the earnings will not be there, the bonds will go into default. So those four factors are there. These four factors tells us that the coming 1 year period is not that really exciting. If there is no earnings, market can never go up. That's for sure. So why the market has gone up from 26,000 to 36,000 or Nifty at 10,600, 700 level? I told you the three reasons: Fed pumping in a lot of money, interest rate coming down, and third important part, a lot of domestic investors trading from home, sitting at home. They are not looking at the fundamentals. I suppose a lot of people should not do the mistakes that they've done in 2006 and 7. People are trading. People should trade looking at the fundamentals of the company and not by those technicals and the numbers which we are there. So that's what the market is right now, and market is going forward will be. Another couple of examples, what I can show you, I can tell you is that why I am little bit cautious about market going up from here, and I want you to play a little bit of defensive right now, or I can say that safeguard your asset right now. I give you one example. TCS. TCS is the biggest employer of India, one of the biggest employer of India, and 75% of their employees have been told to work from home for the next 6 months or 1 year. Now, if TCS told is 75% of his employee, which is a huge strength, to work from home, so what will going to happen is that they are going to buy less. If they're not going out, they will buy less on cosmetics, garments, and all those things. They're sitting at home, and you're going to see the kind of impact that will happen on the general things. So that's one example I'm going to give. So there will always be, this year, always be the sales will be less, because people will roughly do not travel. People will roughly cut off on expenses and all those things because they will be probably sitting at home. So the earnings will be muted, that's for sure. How long will it take for this demand to come up, earnings to grow? It is very difficult to say right now, because as I told you, there's two important things which is still unpredictable. One is the US election, and second is the COVID wave 2 things, which will probably take another 3-4 months time to get clear up. But I presume that from here, as we are sitting on July 2020, from next 1 year, July 2021, market is going to be muted. It is not going to rise from here, much rise from here. It is going to be corrected for sure. What is the bottom level? Well, no one can say. I also cannot say, but I presume that there can be a correction of 15 to 20% from level what we are right now. Another interesting data point, I'm going to show you some data. Before that, I just want to tell you about what I feel like. Today, in the month of March, when we done this webinar, we have told our investor to invest when the market cracked down from 42 to 23,000 level or a 58,000 level. A lot of investors do not invest, they panic that time. And today, when the market has gone up, we have seen there's a heightened investor query, and they feel like fear of missing out. I will say that don't feel the fear of missing out, because it is good that if we are having the fear of missing out, because the market is going to get corrected for sure. What I'm going to say is that from here on, a couple of things which is going to interesting fact, which I'm going to show you. See, if we carefully analyze the FII data, I hope you're able to see this thing. If you carefully analyze the FII data, you see that in equity, in the month of March, FIIs has withdrawn 61,973 crore from Indian market, and that is the reason market has fallen from 42 to 26,000 level, or Nifty 8,000 level. And then FII has slowly pumped in money in the month of May and June, right? But in the month of July till 12th of July, we have seen the FII start pulling out. So this data is important. This is an equity side on FII data. So this data is important. This data is given an indication that FII is going to pull out money from here from now on. So that's one important factor. Second thing I'm going to tell you is Just wait for a minute. Yeah. Second thing is important that if we see the Nifty PE, price earning is one of the major criteria for market movement. If we see the top 10 Nifty companies PE versus top 40 Nifty companies PE, top 10 PE price earning is 30, as rich as 30. So what has exactly happened is that most of the FII's investment and the domestic investor investment has gone towards the top 10 companies of India. And whereas if we see the top bottom 40 Nifty companies PE, which is at 20. So this extremely high. Even if we see the Nifty the moving average PE, which is around about 2021. Right now, the Nifty PE is about 26, 27, which is absolutely high. So if you are investing in Nifty in top 10 companies, you are going to lose money from here because the stock is trading at high PE. Okay, precisely for the Nifty bottom companies, you need to look at the fundamentals apart from looking in the PE also. And I said that in a future projections, earnings will be less, so this is going to impact also. So in a combination of these two things, Nifty P is round about 26 right now, which is not sustainable at any point of time. So that is another factor from the technical point of view, why you should book your profit right now and probably park your money in liquid assets. Couple of assets I will tell you where you should park your money right now. Probably it is better to safeguard your asset right now rather than investing aggressively into equity. Couple of data points I am going to show you, as I showed about the FIS trend about market movements, and next data I am going to show you about. You will see the last couple of months till June. All the market has performed extremely well. The reason I told you, US Fed has pumped in a lot of money, interest rate is going down, and people across the world have started trading from home. The demat account opening in India has increased tremendously. Another data I want to show you is that in the month of June, there's a 80,000 crore cash transactions has happened in demat account, which is much higher than at 2007 level also, and it is a record level, so which clearly indicates that a lot of people are trading from home. But what is the basis of those trading? So probably that is one of the reason. And another interesting data point, that since a lot of retail participation is happening in the market, but we have seen the equity mutual funds, the flow is less. The domestic big institutional investors, the flow is less. It is only the retail equity participation has been higher. That is one of the reason. Second important data point I want to tell you is that a lot of promoters, in big companies, they are because of the cash trap situations, they are actually pledging their stocks and getting funds from there. And a lot of promoters have started selling of their fund stocks also, so which actually indicates that the market is not going to be what we presume from here on. So that's another indicator point that why you should book your profit and safeguard your asset right now. So this is still June, right? So I'm going to show you a couple of other things. The sector price return till June, you see the couple of industries where we have a huge returns. But this is still June. July, I will tell you which sector is going to perform from now on. Please hold on till then. Market valuations, how we take a call about the market is that we normally take market valuations, PEPV, business cycle and trigger and sentiments. We look on all those points. I shown you this data point. Even the price to book value and price to Nifty top and Nifty top 10 and Nifty top 40, there's a huge difference. Despite the difference, you should not go and plug companies who are the Nifty bottom 40. You need to look out the fundamentals before investing and sector specific before investing. I will tell you which sectors are going to be very attractive right now, or what exactly need to be done for your investment and asset class. India's market cap to GDP is 71, which is below historic average. That's okay number. Capacity inflation is also less, which is quite obvious because the numbers, because of business, everything is shut down. Credit growth and deposit growth, you will see the numbers difference out here, which is also so. Credit growth moderate 15 to 6%. So which actually shows that we are at the bottom of the business cycle. Okay. Okay, we're not getting depth into the technical analysis of this. I have my other sessions to discuss about more details about it. I'm going to give you an overview of what the numbers are looking in India. If you see the sentiments, you see the small. This is the like 1 year return, 3 year return, 5 year return, and 10 year return. If you see the Nifty in last 1 year, it is minus. Okay, and then if you see the 10 year return is plus. But if you see the movements of small cap and large cap, it's precisely more or less in the same range, plus minus 1 or 2% range. So that's the sectoral performance is what we have shown out here. Uh, there has been an incremental labor force movements. India will see a huge labor movements going ahead. There's another point which I want to mention because of the China effect. We have seen that a lot of negative informations, negative words are going out towards the China. So a lot of investors and business will come towards India, but that's not going to happen in 1 year time. It will take 3-4 years time to actually eventually move from there. So don't take into that factor only into consideration while giving investments, because if you have a longer duration period, then you don't need to worry. But in a shorter duration, yes, there will be some pain. So don't look much details into this factor of people moving out of China and coming into India. That is not going to happen in 5-6 months time. That will take 3 to 4 years time to happen. Private deep, this is not so important. Forex reserve is also high, but another interesting data is that our current account deficit is increasing. It is already at the range of 5% right now, and because of those moratorium and because of those government measures that they are given, and if it will continue to rise, then the government has no other option but to borrow money or print money from there, and then a lot of problem will arise from there, which is quite obvious because the GST collections, although in June we have a 90,000 crore collections, but keep in mind that is a spillover from April and May. So GST collection will be less because the business will be less. Plus, we have a government moratorium given in various sectors. We have a government, a lot of measures have been given because of the COVID situations. So the problem will be there that if the current account deficit continue to rise, the government has no other option but to borrow money, and that will again impact the economy as a whole. In the debt side, that's what I may show it in the equity side. In a debt side, debt means fixed instrument side. Government GSE yield, 10-year government bonds is trading at 5.84%, and we have seen the corporate bonds which is yield at 6.55%. Corporate bonds in bank, FD, and all those things, and government is the government bonds sector. I don't think so. The government bond has already been lowered. It has been high couple of years back, but it is trading at 5.84%. I don't think so it will go much lower from here. The only reason is that because of couple of factors, like oil price has gone up, slowly going up. We have a huge liquidity inflow from the US government plus different other central bank. So all this thing, I feel that there will be a pressure on the debt side also. And contrary to the lot of economists and a lot of people's view that interest rate might go down from here, I am an opinion that interest rate will be a little bit of stagnant and may also rise in days to come, because I feel and not probably in a steep rise, but coming 6-7 months, there can be a very minute repo rate correction, but not huge correction we've seen earlier, and interest rate can have a little bit of impact from here. So I don't feel that it will go farther down, because government current account deficit is going to increase, and we will have there's a lot of pressure on the yield movements from now. So that's going to happen, and see the inflation as this is CPI inflation, and this is the GDP growth year on year. The GDP growth will obviously be muted from the days to come, and another data point which reverse repo rate we have seen, it is repo rate has seen we have gone to the 4% level. I don't think so. It will remain at this 4% level, plus minus 25 basis point will be there. But it is going to remain there. It's not going to dip much bigger. So there will not, I don't think so, there will be a much deeper interest rate cut from here on. And that is the reason why I say that long duration bonds, long duration government bonds, long duration FD should not be taken right now. So that's not a good asset class to go. Instead of, you can invest in a low duration paper. Low duration FDs and low duration paper is a good options, where you will get a good return out of that. Because bond markets, debt markets, I have a specialized training program for that. and there I mentioned that how the debt market operates. So I presume those who have invested in low duration paper, as I mentioned earlier, they have seen the huge return, like double-digit return they have seen in the last 3-4 months. I presume that that return will be there if you park it money in liquid funds or not liquid funds, an ultra short-term category and low duration paper. So their returns will be there. The reason why I'm saying is that there is a huge gap. There's a huge gap between AAA. This is AAA, and this is the double A spread. Now, double A paper are still at high yields. 9%. This is not sustainable. This has to come down. So if this comes down, the price will go up. If the yields comes down, the AA paper's price will go up. So you will get a huge attractive benefits in AA. But keep in mind that after the moratorium, we are not sure about the default category or the stress in this AA bond paper will have. So that's a separate thing. So this is the collation of all the data. We have these inflation numbers from FY13 to FY20, and we have all the current account deficit. You can see. We have fiscal deficit. This is going to rise, okay? This is going to rise. Current account deficit and fiscal deficit is going to rise from here on. You see already the fiscal deficit has keep on increasing here. So this is 4.8 right now. This is till the month of June data. It is going to increase. Crude oil, we have seen it started picking up. GDP growth will be muted. It will not be 4.2. It will be like around 2 to 3% to go further down. Forex reserve, we have a decency. We have the currency is also is okay. So net overall, I can say that I have told you about why the market has moved from that rock bottom to this level. What is going to happen in the future? That's the number. That's two things I'm saying. So as an investor, what you need to do that I will say that it is important that to safeguard your asset rather than looking for a huge incremental return right now. If you already invested in equity, I will suggest you that book your profit and park the money in a low duration paper, probably low duration bond paper, low duration government bonds paper. There you will get a little bit of return. Probably there I see there will be a correction of 15 to 20% from here on. That correction, when it will come, it can come anytime. So I just showed you the data. The FII started pulling out the money. I have shown all the data. Nifty PE, the overall PE is trading at 26, 27, which is not sustainable, which is much higher than its long-term average. Market in March was very cheap, but market in July is not cheap. Okay, it's not cheap. The valuation wise is already stretched overall, if you see. But yes, there are a couple of stocks which are very attractive. Couple of segments which are very attractive. But I will say that wait before getting enter into those sector right now. So the couple of sectors, if you see the stock specific, you see the industry specific, I will say the banking and financial will be the stress asset going ahead. Obviously, you know the reason, because a lot of corporates will not be making money. The revenue will be less, the earnings will be less. And so there will be problems in corporate earnings, and it will reflect in the banking assets. So bank and financial services will be stressed. If you already have invested there, I will recommend you to, if you book profit and stay on cash for a couple of months before you reinvest in itself. Second thing, auto and auto ancillary, you see the data, they have already gone high. They're not very attractive. Couple of sectors which I feel is attractive is agriculture. Agriculture is extremely attractive right now, so you can look into the agricultural sector. Second interesting sector will be PSU. A couple of PSU value stocks will be very important because they have not grown in for last 4 or 5 years. PSU will be a good pickup time. There are a couple of PSUs. I will not mention the name in this seminar. They are actually available at much better price. So on a nutshell, in an equity, I will suggest that sell off and park money, or if you have a longer duration period, buy for only stocks which are fundamentally right and not on the pricing. You have to see the entire fundamentals. Secondly, if possible, you book your profit and stay on a cash, because there will be 15-20% correction from here on. Second, I will mention that park your money in low duration bonds. Low duration bonds are good bonds to buy from now, because that is going to give you good return. Third important asset class will be gold. So I am very bullish on gold right now, because whatever the central government of different countries have taken steps, if it goes wrong, if the market deteriorates, if the economy is much under stress from here, only asset class will give you return is the gold. So I will presume that if you have 100 rupees right now for investment, park 15 to 20%, 15%, 10 to 15%, obviously in gold right now, if you see a huge rise in gold. So that's gold as an asset class. Second, I will say that invest 70, 80% of your money in liquid assets, in low duration bond paper, or low duration FDs and those kind of paper. And third, I will say that if you are willing to buy stocks, buy only stocks which are fundamentally goods and which are the sector which I mentioned earlier to you, and book profit from the most of your stocks and stay on cash or those gold and liquid asset category, and reinvest after probably in 5-6 months time when the market will again move up. But whether the market from 36,000 level or not level near about 10,600 level to go back to the 7-8,000 Nifty level, I don't think so, because it will not go depth. But yes, there can be a chance of 15-20% dip from here. So that's what all of my presentation is all about. So on a summary, I can say that going ahead, economy will be under stress for obvious reason. We all know what is happening in the economy. We all sitting at home. The market is not moving up. The real market is not moving up. Only the stock market is moving for the last 2-3 months because of the reason I told earlier. So if the earnings is not there, if the moving is not there, so market, fundamentally it should not grow up. Market has already corrected in the month of March from 42 to 25,000 level, and I don't think so that rock bottom will come, but 20% correction is very much of evident from here on. That's what's all from my side. So on a nutshell, invest in gold, invest in liquid assets, and pick up stocks which are fundamentally good in the sector which I have mentioned. Okay, and don't get carried away by the funds with the shares which are already rock high prices. So that's what's all from my side. If you have any questions, you can always ask me in a Q&A sections on the left hand side of your screen. So I am happy to answer those questions. Thank you.